You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zacks Investment Research. Learn more by visiting them online at zacks.com. Welcome to Profit from the Pros. I'm Terry Ruffalo. Trading was volatile this week as investors remained edgy over Japan's nuclear crisis while spending much of the first part of the week trying to assess the fallout of the situation. Stocks took a drubbing on Wednesday in a rout that wiped out S&P and NASDAQ gains for the year, but the tide turned about Thursday as investors shifted their focus away from Japan and back to the U.S. economic recovery. The Fed met this week only to announce that they'll keep interest rates and their QE2 program in place, which was in line with expectations. Disappointing news on housing starts showed the steepest monthly drop in 27 years, with permits at a record low. Data also showed upticks in both producer and consumer prices, but weekly jobless claims fell last week and U.S. manufacturing output rose for the sixth straight month in February. We'll get more about inflation at the roundtable in just a little bit. Shiraz Mian, investors needed Dramamine this week with all of the up and down in stock prices just to stop the motion sickness, it looked like. Are you concerned that all of the global unrest might really shake investor confidence going forward, or not yet?
I am. I think the uncertainties that we are seeing globally, and thankfully all coming from outside of the U.S. shores, unsettles investors, unsettles the market. It gums up the pricing process and the pricing mechanism that the stock market does so efficiently. So it is a concern, but my feeling is that as long as the core fundamentals of the U.S. economy remain on the trajectory that they have been over the last 3 to 6 months, we should be in good shape. These boats of uncertainties and then concerns resulting from that would result in these day-to-day downtrends in the stock market, but overall the trend should be positive and upwards.
Gums up the works, as we used to say down
That's
on
right.
the farm. But even though that is your outlook going forward, which is kind of on the positive side, volatility is still going to remain the watchword for a short time longer?
It will. And even after we are through with the fears coming out of Japan, Middle East will remain a concern. I personally don't think that we will have major disruptions to oil outside of what's going on in Libya, but the whole region, which is so important for global oil supplies, will remain in this unrest and instability region, and it'll produce this backdrop of volatility in oil prices. And given the significance of oil to the U.S. as well as the global economy, my sense is that the volatile oil prices will keep the stock market volatile as well.
Okay, Bill Wilton, equity strategist, waiting in the wings over there patiently. One positive is what you want to bring to our attention, I guess, in the midst of all of the negativism that's out there, and that is the fact that you say right now is a good time to consider growth stocks. Why is that?
Well, you guys mentioned a lot of bullish things. You know, you talk about the manufacturing output that the Philly Fed talked about earlier this week. Employment's improving, you know, and like Shiraz mentioned, the overall trajectory of the U.S. right now is very positive. And one of the reasons that it's a great buy right now is because there is some uncertainty out there. It's shaken off some of those weaker hands, brought the indexes down a little bit. So we're able to buy on the dip, as we call it, getting a little bit better price than we normally would, but still able to capitalize on that growth that we're going to be seeing, you know, moving forward in the long-term trend of the overall economic recovery.
Yeah, makes sense. So share with us then, if you will, some weekend wisdom on how one would go about finding these growth stocks if they were so inclined.
Well, growth stocks are pretty easy to find. The trick is finding good growth stocks.
Adding value to them.
Yeah, anybody can find a high growth rate, but putting a price on that growth rate is what you really want to do. My favorite tool is the PEG ratio. Takes your classic PE and then factors in that long-term growth rate just to see how much you really should be paying for that growth. Because a lot of investors will say, you know what, it's going to grow 50% every year. I want that stock. But if you're not putting a proper value on it, you're going to be overpaying for that, and you can really shoot yourself in the foot that way.
All right. It can't be an easy task, though. I mean, it can't be as easy as it sounds.
Well, it's definitely not. There's a lot of other factors you want to look at, metrics like price to sales, because earnings can be tweaked accounting staffs, they've got a lot of liberal rules that they can follow to make the earnings look a little bit better. Also, you want to look at the cash flows to make sure that they're able to run their day-to-day business, to make sure that those earnings targets are actually attainable, and not to mention that they can actually keep the business running.
Okay. All right, Shiraz, you look like you're agreeing with him there. Growth stocks, good time for them right now?
I think they do. They are relatively riskier than the typical large cap stocks, so they have fallen relatively more. And as Bill rightly mentioned, you want to buy on the dips.
All right. Next week, quickly, big economic news going to be the GDP numbers that come out for the U.S. economy. What are you expecting to see there? Real quick.
I think the trajectory that we've been seeing from Q4 2010 remains in place. I'm looking for strong numbers.
Okay, you are going to be back with us at the round table. We hope you are going to stick with us all throughout the program because we have more still ahead. Stay with us. Here is your Bull and Bear Stock of the Week. This week we have an apparel company and we have a lawn, garden, and pet supply company that make up the Bull and Bear of the Week, and Shiraz Mian's going to fill us in on both of those and the reasoning behind why they are what they are. First, Polo Ralph Lauren Corporation, that's the Bull of the Week. Sales are pretty good. Retail sales are doing pretty well, just in general.
That's right. And for them, for Polo, and broadly for the luxury segment of the retail market, they're doing very good. Polo, in fact, didn't even experience a minor drop in its earnings during the downturn. So they have been on a regular upward trajectory in their top and bottom lines throughout the downturn when many of their peers stumbled.
I see.
Two main reasons: global, recognized, prestigious brand that has a great opportunity for growth in Europe and Asia. Number two, a very solid balance sheet, which is giving them the flexibility to fund the growth as well as return excess cash to shareholders. Briefly on the brand aspect, there is pressure on the apparel side, both cotton and all these different commodities, and it's pressuring the apparel manufacturers. When you have a brand like Polo has, it helps them buck that trend. So they are able to pass that on to the end consumer and then some. And we are seeing that in Polo's results and in Polo's estimates. They had exceptionally good same-store sales in their own retail segment, which roughly accounts for about half of their revenue. They're also seeing very good momentum on the wholesale side where they supply to the department stores.
Right.
Margins are on the up, and we are seeing that in estimates. Typically in the global space for luxury, it's one-third for North America, Asia, and Europe. They are less than one-third in both Asia and Europe, and that's the growth opportunity for them.
And they also, we call them an apparel company, but they also have a line of fragrances that they market too.
They have accessories, and that's a great growth opportunity for them, primarily in their own retail outlets.
Helps them buffer some of that pressure.
It sure does, and it's a more higher margin product mix than the regular apparel products.
Okay, quickly, Central Garden and Pet Company, CENT, on the NASDAQ, is that lawn, garden, pet supply company. Is this company just too diluted in their line?
It is. I would have personally preferred to have them as the Bull of the Week with spring coming and all.
Yeah.
But this company has fallen on hard times. They haven't been able to pass through the commodity price pressures that we referred to, that Polo is finding so easy to pass through. So commodity price pressure is a key reason for the harder times that this company has fallen. Their numbers have been weak in the last couple of quarters. Those are admittedly the seasonally weak quarters for the company, but they were even weaker than what they would typically have been on seasonal terms. So the margins are under pressure. The company is doing something on the top line, but it's not enough to offset all of the problems that they are showing on the bottom line, and we are seeing that that showing up in estimates. Estimates have been on the downtrend for some time now, and my sense is that that downtrend will remain in place.
Okay, thanks for the information. Stay tuned for stock screening next. Screen of the Week, an overview of a timely strategy aimed at helping you become a more effective stock screener. This week we're talking surprises. Surprise, surprise, surprise. I couldn't resist. Kevin Matris, our top stock screener here and market technician. But all kidding aside, I'm assuming we're talking about earnings surprises.
Right. By the way, that's Gomer Pyle, right?
Yes, it is.
Okay, good. Yeah, we're doing earnings surprises and we're doing sales surprises. And having just wrapped up earnings season, you know, what's interesting is that we saw a lot of double-digit price responses. Company, you know, beats earnings. We see the thing skyrocket. They by a small degree, you see these things just collapse, often in gap fashion. So why the market reacted so aggressively, that's an interesting topic. But for today, all we're going to really focus on is why an investor should care so much about surprises.
All right, and so I'm assuming that positive surprises are still good.
Yeah.
That part of the world hasn't changed?
Right, everything is good there. But what's interesting is that, of course, company reports a positive surprise. You should see the price go up. A company, let's say, underperforms expectations. That's a negative surprise. You should see prices go down. But what's interesting is that a surprise is more than just a snapshot of what a company has earned in dollars and cents. It's more of a look into the future about what a company could do or should do in the future. And, you know, when these surprises occur, you know, the market scrambles to try to figure out how to reprice their earlier expectations to match what they believe is going to happen in the future.
So am I detecting there that that's a bit of a catch?
Well, it's not really a catch, but I mean, some surprises, for example, are better than others. So if you see an earnings surprise, that's fantastic. But if you see a sales surprise, I believe that is more important because you need to see top-line sales growth for a sustained price move. You can only cut costs so much. So if you see a sales surprise, you should be able to get more mileage out of that in the future.
Then there's guidance, too, we can't forget about.
Yeah, you know, guidance is very important because if you see a company post a positive earnings surprise, but then they follow it up with a downward revision or downward, have just taken away all of the hope that they, you know, typically would accompany a surprise. Because if they just said, hey, yeah, we did fantastic, but things ain't going to be that great in the future, why should people rush out to buy that stock? And that is one of the reasons why you'll often see negative price reactions accompany those kinds of events.
Okay, so let's run down the parameters.
Sure. By the way, it's important to note that when you do see a surprise, oftentimes the price response can last for anywhere from 1 to 3 months. So what we are looking for is we want to find companies that have posted a 10% positive EPS surprise, a positive 10% sales surprise, and for good measure, we want the average broker rating to be less than or equals to 2, so we're looking at varying degrees of strong buys and buys. That sets a good table for us.
Okay, and stocks that have come through the screen.
Yeah, there was probably about 50 or so companies that met all of these requirements. Here's 5. We've got Brightpoint, Clico, CVR Energy, Navios Maritime, and Mastech. Different companies in a lot of different industries. They've all been able to show very nice surprises on both top line and bottom line, and these companies look poised to be able to make some impressive gains in the future.
This may be an obvious, but I'm going to ask it here anyway. Is earnings season the only good time to run this screen? Well,
you know, not all will hit during the exact earnings season, but I would say look at it any time. Even if a company you see has posted a positive surprise, let's say a month ago, since we know that oftentimes you'll see a price response 1 to 3 months after the event, it's always a good time to look at it.
Okay, do you own any of these?
Not yet.
You're back with us at the round table, and we invite you to stick around for it as well. There's more still ahead. Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Market gyrations, inflation pressures, and top stock picks. That's what we're talking about at this edition of the Roundtable with our research director, Shiraz Mian, who rejoins us, as does that market technician, Kevin Matris, and Tracy Reinick, equity strategist, back for a return engagement here at the stock roundtable. So let's talk about stocks this week, since I brought it up. huge market reaction to what's going on in Japan. Was it overdone? Was the reaction by the market overdone?
You know, the markets hate uncertainty, and that's all we saw this week. I mean, every hour it seemed there was like these new updates on not just the tsunami damage, but with the nuclear crisis. And, you know, it's something that hasn't happened in 25 years, this kind of nuclear crisis. So it's not surprising that people got jittery, especially after the rally in U.S. equities that we've seen, that people were taking some profits off the table. Were they trading on fundamentals? No. So is that overdone? Maybe partially. But, you know, you can't really blame people when you have these kind of world events going on for just going to safety.
But Kevin, markets have seen uncertainty before. I mean, we've been seeing uncertainty since Libya broke out, Egypt. Is the difference this time the potential magnitude of the situation?
You know, look, the situation in Japan is extremely serious, right? But I really do think that the market reaction is a bit overdone. If this had happened at any other time, let's say last year or 2 years ago, when the global economy was on the downswing, that could have been the kiss of death for everybody around them. However, though, everybody's economy seems to be ticking up, and the U.S. economy is in one of the best positions it has been in a long, long, long time. So the one thing that everybody has to realize, too, is once this nuclear issue is contained, and once everybody knows what they are dealing with, there is going to be a massive mobilization, a massive rebuilding effort, and people are right now trying to figure out how are we going to be able to rebuild Japan, and that is going to usher in a whole new impact, a whole new thing of economic growth globally.
Well, talking about economic issues related to this incident, Shiraz, U.S. runs about a $60 billion annual deficit with Japan, and according to published reports, our exports to Japan are only about 5%. So at this point, is it safe to assume that any impact to our economy is going to be negligible?
It is. I firmly believe that, and I would completely agree with Tracy's assessment that when you throw in the extent of uncertainty as the nuclear situation brought to the market, just to quote Don Rumsfeld, it's an unknown unknown. Who knows what that would do to the global economy, what that would do to Japan, and markets typically overreact and move away from fundamentals in circumstances like that. So no surprise, but it was overreaction. Japan's impact on the U.S. recovery, I all along believed was minimal. If we contain the nuclear aspect of it, there would be a minor dip in the first half of 2011, followed by a reconstruction, as Kevin alluded to, and that'll bring back all the lost growth from the first half. So net, it's not enough to derail our econ recovery.
Okay, let's talk about the economy here a little bit, Kevin. Bring it a little closer to home. We had inflation data that came out this week, and it seems to be the pressure is mounting tick by tick as far as the inflation picture and data is concerned. What are you making out of it?
Look, inflation is on the rise. And most notably, you see it in food, you see it in energy, of course, so that is really impacting everything. But, you know, I do not believe right now it is enough to impact growth, nor enough to be able to derail the stock market, nor enough to be able to change monetary policy, because we are still below the Fed's stated target of 1.7 or 2%. So it is true, PPI is rising, CPI is rising, but I do not believe there is any cause for alarm just yet. Everybody's going to be watching it. This is a potential headwind down the road, but right now I think we are okay.
All right. I'm going to hinge off of part of what he said. Even though inflation pressures don't bleed through to the retail level just yet, and maybe they may have to start including food and energy as a factor in these decisions that they make about how bad inflation is, at the wholesale level, with producer prices, if it continues, those prices continue to go higher, could put the old squeeze-a-rooney on corporate profits down the road.
Sure, it's going to affect margins. We're already seeing this. We just saw it this week when Nike reported. They said they're seeing the increase in costs all the way through the system, and you can see it definitely in the emerging markets. all the way through the costs. And with the high price of oil, that's still working its way through the system too. So yeah, we could see definitely an impact on the margins coming up in this next quarter.
Okay, Kevin,
But I
quick.
do want to say at these levels, the increases are relatively small. So even if you were to pass that to the consumer has the capacity to be able to absorb those costs at this point.
Okay, give us your top stock pick of the week.
It would seemingly look like a stodgy old world stock, DuPont, but don't think of it as
Sorry, I'm still in that world.
don't think of it as a specialty chemicals. I consider it as an applied science company. They spend about $1.5 to $2 billion on R&D, and they have an excellent track record of bringing new products to the market. In fact, about a third of their revenue this year would come from products that have been 4 years or less on the market. So excellent prospects for them. They also have exposure to the solar energy revival, and on top of that, they pay a good 3.5% dividend. So
Cool. What
excellent stock for these turbulent times.
What else do you want? Kevin?
Delek U.S. Holdings, ticker DK, they are in the oil refining and marketing industry, and they do a lot of course, petroleum refining. They also market fuel and different kinds of things. Top ranked stock, top ranked industry. They just posted a 6.6% positive EPS surprise and a whopping 26% sales surprise. Taking a look at the chart, I see the price target as being $15.75. That's a 25% increase from here.
Okay, got to move. Tracy.
I have Tractor Supply, which has about 1,000 stores in mainly rural America, and they supply the small farmers, the hobbyists, and a lot of lawn and garden, and they have about 17% earnings growth.
Okay, well, we thank you all for that. Thank you for joining us. That's this edition. We hope the week ahead is a profitable one for you. We'll see you next time on Profit from the Pros.